Welcome to this week's Q&A. We've got a general investment question from one of our viewers in Sydney, and he's asked, should I buy shares or property with these fears of inflation that we currently are seeing everywhere around the world? So, great question as always, and it needs to be, I guess, viewed in greater depth than that, because inflation is such a very topical issue at the moment, and there are various views as to the cause of this, is it supply bottlenecks, etc. The magnitude of this inflation that we're going to see, and most importantly, the duration. So we've seen a lot of talk, obviously, from central bankers, from the Fed and the RBA, which we'll focus on in particular here, saying that they still believe that some of these inflationary pressures are transitory. Some of them will be addressed as these supply bottlenecks become addressed over the course of the ensuing 12 to 18 months, and that inflation will then come back down between the upper and lower, if you like, band that these central banks are looking for inflation. So important to look at that, because if this is going to play out that way and everything is going to be handled very, I guess, smoothly, then the outcome will be a positive one. However, the problem, of course, is that nothing always goes according to the playbook. So, if this inflation doesn't come back down and it's not transitory, and central banks may then perhaps have to increase interest rates far more than they had anticipated, and that could then cause some recession to come into world economies. So at the moment, property and equities are still the preferred options to cash or bonds. And there's a very simple reason. As a lot of our clients will know, if you have cash, you're getting virtually no return on that in terms of interest rates for deposits. And similarly with bonds, most bonds currently, especially the higher quality government, semi-government bonds, are paying a very low yield and perhaps a negative real yield if you're going to hold those assets. So that's something that everyone looks at, says, where can I get some yield? But it's not the inflation, but the central bank's response to that inflation that we've got to keep an eye on and see how that's going to potentially impact our asset portfolios. So looking at Australia now, if we look at the Australian mortgage market, it's generally had its greatest exposure, or people have had their greatest exposure to variable interest rate loans. And in this current cycle, that's changed quite a lot, actually. So many people have now opted for fixed interest rate loans, which have been, in most instances, far cheaper than variable rate loans. And perhaps I think the more prudent of these people have locked those rates in for longer periods of time. So say 4 and 5 year fixed rate loans. And we've certainly advocated to our clients where this has been appropriate for their personal circumstances to do so, because it gives you peace of mind. And let's say that the inflationary pressures are greater than central banks thought, and they have to raise rates more aggressively. These people can then have that peace of mind of knowing that they're going to be paying whatever their interest rate is for that period of time, and they may actually be able to go through this current interest rate cycle and perhaps come to the other end without having had any negative impacts in relation to their personal cash flows. So pretty important, but everyone's situation is different, and everyone needs to get advice in relation to their own circumstances before they choose to potentially act in that way. So we've now got this much larger share of fixed interest mortgage lending in the Australian market. And what's happened, particularly over the last month or so, is that banks have now raised their fixed interest rates fairly substantially in some instances, as certain funding processes have dropped off, term funding facility in Australia and so forth, and as banks recognise that their funding costs are going up to fund these fixed term loans, and they're passing them on obviously to their retail consumers. So the other thing to look at, I think, is that inflationary pressures look quite different in the US to Australia. I think the US is far more progressed along this manner. Inflation there is far greater than we're seeing printing in Australia at this stage. There are some wage constraints. I think they're in a different environment, and we need to look at how that's going to play out overall, especially when it's impacting our Aussie clients or our Aussie expat clients with their property holdings within Australia. So again, that's something we need to bear in mind and see how that actually impacts us. One thing I could say, or I will say, is that I think we're late cycle in this current expansionary period that we've been the beneficiaries of for quite a number of years. So what assets tend to, I guess, perform better when we're late cycle? And historically that's generally been real assets, so property, commodities, and we need to obviously then look at how we're going to distribute the assets within our overall asset portfolio. Now, if it's shares, buying shares in higher quality businesses that have pricing power, that have strong balance sheets, so they're not over leveraged, and if they have input price rises, they can pass those on to their consumers and protect their profitability. And the property market is similar. So if you have or purchase high quality assets that are generally in shorter supply, so high quality dwellings in sought after locations, you're going to have the same outcome. You're going to be able to have some pricing power. You'll be able to maintain higher rental incomes because there aren't that many of those properties around, and also you're going to protect capital value. So very similar to equities, and they're both growth assets, but the one thing to bear in mind is that far more people use a substantial amount of leverage when they're buying property, investment property, than they do equities. So if you've got a margin loan on an equities portfolio, that's a mark-to-market asset, and you've got to be very careful that you have sufficient liquidity perhaps to meet any margin call if those assets dropped in value by 10, 20, 30% at any given point in time. That's not the case clearly for leverage in the property market. So that's something that is important to recognise and bear in mind. So look at high quality assets, buy companies that have pricing power, buy properties that have unique attributes. If you found this helpful and interesting, please subscribe to our YouTube channel and click like. And I look forward to seeing you next week with a new question in our weekly Q&A. I'm Andrew Unterweger from Wise Guru. All the best to all of our clients in Australia and all of our Australian expat clients around the world. See you next week.